So how can you create your paycheck and making sure it's going to be steady during a market drawdown? Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy Blog podcast, where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. This is the last episode of this marathon, and we could call it that way, on how to invest in 2025. How are you doing, Vero? Do you still have some energy left?
I do. But listeners, you don't know this, and you won't notice also because I'm doing the editings. But it was quite an adventure to do. We had like dogs barking, construction going on in my street. Anyway, so I mean, it's the last one, but it's not going to be the least. That's for sure.
Yeah, it was quite a challenging moment. Pretty much like what we're going to face in 2025, actually.
And Mike, that's a good introduction for the topic of today, because we know now that the transition from the accumulation phase to retirement, can be hard for investors. Each year of retirement can bring doubts, as we don't know if the market will be on our side and allow us to live as comfortably as expected. Fortunately, there are ways to prevent these uncertainties, and this is what we will discuss today.
Yeah, it is a completely different mindset when you go from accumulation to decumulation. The thing is, all your life, you work, you generate money, you invest. So when there's a market downturn, you don't mind too much because you're just thinking, oh, I'm buying more of what I like. So I'm gaining actually a deal. But when you get into the decumulation phase, it's already tough to withdraw money from your portfolio. It's even more difficult when that portfolio is going down by itself. It's kind of like double dipping. And we know after the holidays, no double dipping allowed, especially for young kids, right? So brings up the fear of outliving your portfolio, and that is a sentiment that nobody should feel. Unfortunately, it happens every single time the market goes down because it's freaking out, and our mind usually tries to make patterns out of like what's happening around us. So if after month 1 you're going down, and month 2 you're going down, and month 3 you're going down, well, of course you're thinking, well, for the next 3 years, it's going to go down, and I'm going to enjoy craft dinner more than ever going forward. And I don't think you should deserve to be stressed like that. I think people deserve a happy and stress-free retirement. So we're going to try to shed some light on how you can create your income during those market drawdowns.
But before we offer you solutions, first, Mike, we need to know, how much can it hurt a portfolio to cash in on some shares during a down market?
So if you look for sequence of withdrawals on the internet, you're going to find a lot of graphs showing you the difference between two investors. Investor A starting with a 15% decline, let's say, or 10% decline on the first 2 years of its retirement. So he's withdrawing money, but at the same time, he starts at the worst possible time. So think about someone would retire like in the summer of 2008, just before Lehman Brothers declare bankruptcy. And then investor 2 would be just an investor that is relatively lucky, just investing in a regular market. So having a few years of positive returns before experiencing the same 10, 15, 20% decline over 1 or 2 years. And the result is incredible. Like investor 1 with the same amount of money would probably be able to live off his portfolio for like 17, 18, 20 years. And the other one would be good for like 30 years, just because of the sequence. So in other words, look at your crystal ball carefully before retiring. Because if you have to withdraw money from your portfolio on a bad year and you started your retirement right before a market correction, you will have to review your financial projection very quickly.
So, a good way to prevent that is to invest in income focused products like annuities and the likes, right?
Yeah, so one way to protect yourself against market drawdown is not to be in the market or actually give that problem to somebody else. So when you
Mhm.
purchase an annuity, you purchase that from usually a life insurance company that will take all the responsibilities on their side. So it's great. So you get a pension. It's like building your own government or defined pension plan. You just write down a check and you receive the money and you don't have to worry about anything else. Even better, you can add clauses where your annuity can increase over time to match inflation. You can also add other clauses that if you pass away at an early age, your money is not wasted. So a part of the annuity can be transferred to your spouse. Those clauses, of course, are very interesting, but as anything else in finance, there's no free lunch. It will be costly.
Mhm.
The downside of an annuity, first, it's a fixed income. So if you buy an annuity paying you like $2,000 a month, well, if you need 2,500 on a month, a specific month, it's not going to work out this way. You cannot. If you need to withdraw $25,000 from your investment, you cannot call the annuity company and ask for an advance on your pension. You will have to wait, save, and budget accordingly. So there's less flexibility. The right way to plan the annuity is probably to do it for a part of your portfolio. So
Mhm.
then you can have a part of fixed income that is coming up and you don't have to worry about anything else. And for extra expenses, for unexpected expenses, then you can still have money invested in a classic portfolio where you can have access to it.
Another way to do it is to create your paycheck with a cash reserve. How do you do that?
So the cash reserve strategy has been explained several times on this show and
Mhm.
across our newsletters and everything else. It's actually the strategy that I intend to use on myself. Uh, I don't want to leave my portfolio into another companies to build an annuity. So I prefer to manage it myself. But again, I'm well aware that if I have to withdraw money during a bad year, I'm going to greatly impact my portfolio returns going down the round, and probably that I will have to review my financial projections. So in order to do that, you can protect your portfolio by putting a part of that money into a bond or a GIC ladder over 3 years. The idea of like 3 years period is to cover most bear markets. So on average, a
Mhm.
bear market will take 18 months to 2 years to recover. Of course, you're going to have major bear markets such as the financial crisis of 2008 and the tech bubble of 2000 that took about four years and a half to recover. So at 3 years, you're kind of like in the middle where you cover most of the small drawdowns and you are able to recover from most of them. So the way it works is on a good year, you sell shares. So you reconduct that ladder, that bond ladder for another 3 years, and then you're good to go. On a bad year, you will take money from the cash reserve. Eventually, you will have to replenish your cash reserve if you're taking like 1 or 2 years of your GICs. So of course, eventually you will have to sell more shares on good years. But keep in mind, the whole goal here was to save money so you can enjoy your retirement. But at retirement,
Mhm.
it is normal to see your portfolio decline unless you save so much that you can just live off the dividends or live off the income and not touch the capital. That would be the perfect solution. Unfortunately, it's not always happening, mostly because the amount that needs to be invested in safe dividend paying stocks. Because, of course, if you target high yielding stocks, you will be able to um, go through a few years enjoying a high yield revenue. Everything's going to be fine. But when you will have that market downturn, chances are a lot of companies there will cut their dividend, or a lot of income focused products actually eventually cut their distribution. And it's going to be very, very painful to recover from this, or almost impossible, because you're going to lose income and you're going to lose capital at the same time. But of course, if you need $50,000 a year to live on the retirement and you have invested $10 million, you don't have to worry about this part.
Also, retirees must consider other sources of income, such as government benefits, real estate, pension plans, etc. These sources can be game changers during drawdowns.
Yes, because we often forget about this, but we do have some kind of like annuities built in our retirement plan, especially with government benefits, because those are literally annuities. You have a monthly paycheck, it's adjusted with inflation, so it's literally the definition of annuity. If you're lucky enough, you also have a defined pension, which is great because, again, that is like guaranteed income coming in your account every month. I like to say that people with a pension plan like this are hidden millionaire. They will never see $1 million in their portfolio, but they definitely have more than $1 million of value invested in that pension plan, so it can pay your retirement forever at a pretty nice rate.
Mhm.
So this is important to consider, mostly when you're about to look at your asset location for the liquid part of your retirement plan, so your portfolios. So we're talking about like retirement accounts, non-registered, TFSAs for Canadians, yet like Roth IRAs and 401ks for Americans. But sometimes we make the mistake of like thinking, oh, I have like $500,000 in those accounts. This is all the money I have to fund my retirement. So therefore, I should add some fixed income, some bonds, some GICs. But if you have like a large part of income generated from government benefits and pension, or even rental properties, well,
Mhm.
therefore, you may be able to take additional exposure to stocks for your liquid portion of your portfolio. It's a good way to factor everything. So it's hard to give a defined value when you
Mhm.
were thinking about like annuities, benefits, and pension, but at least consider it in terms of like how much you generate from your portfolio and what are your other source of income, because during a market drawdowns, maybe you can just use your basic income and go a little bit smooth on the withdrawals from your portfolio on those years.
Mike, we are about to share such exciting news with listeners. I can't wait to see their reaction. Over the years, we have seen how Canadians need guidance and support to transition to retirement, and we've decided to create Retirement Loop for them. What is Retirement Loop?
So, Retirement Loop has been created to answer a big problem in the industry. So, a lot of people, they want to manage their portfolio by themselves, they want to take control, but they do still have a lot of questions about when is the right time to convert their RSP into a RIF, when is the right time to take CPP and OAS, and all the other questions like such as when can I retire, how much can I spend, and what is the best way to minimize taxes. Their only solution is usually to go see a financial advisor. Unfortunately, the way that financial advisor are like paid, they're more interested in selling investment products than actually doing that kind of work. And I'm not saying that none of them are doing it, but a lot of people thought maybe I couldn't do it myself and I can learn how to build my own plan.
Mhm.
And once I'm retired, making sure that everything is under control, I make the right checkpoints, and that the ship is steady. And this is exactly what Retirement Loop is. It's a retirement community where everyone can help each other. So, plenty of people that are about to retire or that are retired already, enabling to share their experience and learn together.
But, Mike, what tools, resources, or connections should members expect in this community?
So we decided to divide Retirement Loop in three. categories. We have the planning space where you're going to build your own projections. So you're going to find tools on how to build your projections, build them, and then optimize your taxes. Then there's the part about investing, because yes, it needs some money to retire, apparently. So we're not going to talk about like how to find stocks as we do at Dividend Stocks Rock, but rather talk about various strategies such as like ETF, bonds, stocks, covered calls, you name it. So the goal is how you can create your paycheck at retirement using a good strategy. And then there is the enjoy part, because retirement is not about finance, it's about enjoying life, right? So you work super hard, and at retirement, it's time that you enjoy the life. So we're going to talk about traveling, staying healthy, talking about other hobbies. So the goal is really to enabling that connection across many people in your situation, looking for answers and having a good time to just enjoy their retirement a little bit more.
And as soon as we publicly launch the community, there will be a limited time discounted price offer, right?
Yeah, and that was kind of crazy. We did a pre-launch among DSR members, and we have over 500 members already.
Mm-hmm.
So yes, there will be a special price. It's coming up, and that price is going to last for just a few days, and then we're going to close the doors, because the goal was not actually to reach 500 members on the first year. So I'm almost putting the brake right now to not let too many people in, so we can all have a nice experience and that we can grow as a community. But definitely, I think we just hit the nail right now, having the a great service, helping the right people.
Mm-hmm. So think about that, listeners. Over 500 members ready to welcome you. You don't want to miss this. So join the waitlist now to get more details and access the discounted lunch price at thedividendguyblog.com/loop. thedividendguyblog.com/loop. I'll see you there. But Mike, in which order of sources would you withdraw your money?
Oh, that is a great question with 10,000 different answers. The classic, if you want to optimize your taxes, is usually try to defer as much as possible the time that you're going to pay tax on an investment. So, for example, trying not to withdraw money from registered account that would be taxable income, and if you could divide those amount between you and your spouse, so you hit lower marginal tax rates. Those are like two major guidelines that are very important. But the real answer is you must do a financial projections and look at what if I empty my retirement accounts as soon as possible, pay taxes up front, and see how it's going to evolve after that. Or if I wait until the maximum age, so in Canada, it's the RIF at the age of 71, and then
Mhm.
you are forced to withdraw money and get taxed on it. So it's really a crunch number game. You have to look at alternatives and different scenarios to determine which is the best route. It also depends if you have like a pension that comes into play or not. So if you have like no income sources, maybe it's worth it to withdraw more money at first. So all of those things will have an impact. So that's why you really need to run some projection numbers before you take a decision.
Listeners, if you enjoy this kind of discussion, that is exactly what we aim to do at Retirement Loop, our new community for retirees. Who is Retirement Loop made for, Mike?
So we have created this amazing community. It started on a really good, strong pace, strong momentum in December, and we're closing doors shortly. Uh, Retirement Loop has been created to help people in their transition to retirement. So people about to retire, maybe like 5 years before their retirement, but also for people that are retired already. Because there is one thing to prepare for retirement, but after that, you want to make sure that you're always on pace and on the right path. As
Mhm.
a member said, he wants to make sure that his ship is hold steady, especially when you're running through a storm, right?
Mhm.
One thing that is great here is when you're thinking about personal finance, you're thinking about your portfolio or retirement planning, uh, it's hard to discuss that with your friends and family. Most of the time, money is taboo and it's hard to get real answers from people around you. So we decided to create a place where you have mutually aligned interest for all members and a safe place where you can ask questions and get great answers and help each other grow and plan and build that retirement plan. So you want to grow as a community, you want to help each other, and you find the right place in Retirement Loop.
Mike, where can listeners get more info about the community?
So doors are open for this week. So it ends on January 6th, but we have a price increase tomorrow. So the best price you can get for Retirement Loop is today. So you really want to hurry up. We're going to make the link in the show note, and you
For
can
sure.
also go at Dividend Stocks Rock / Retirement Loop in one word. So Dividend Stocks Rock / Retirement Loop, and you will end up into the subscription page.
If you can't remember the link, no worries. It's going to be in the show notes. Same as usual, thedividendguyblog.com/208. This concludes our How to Invest in 2025 small series. I hope it gave you useful guidelines for the year, listeners. Again, as always, thank you, Mike, for helping us invest with more conviction. Listeners, download your Top Stocks booklet now at thedividendguyblog.com/topstocks and visit our show notes for all the resources we've mentioned throughout the week, including Retirement Loop at thedividendguyblog.com/208. Help us grow this podcast in 2025, please. This is the last thing I'm going to ask you this week by subscribing to the show, leaving us a 5-star rating, and sharing it with your friends. Until next week, stay
Stay
invested.
invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.